Maybe we just wait for 2-3 minutes more for everyone to log in.
I think we should just wait. In the meantime, welcoming all our participants, clients for taking time out for this webinar. So we'll wait for a few more minutes and then maybe we'll dive into the conversation on the budget. Thank you. Radhika, we should start, I guess, right?
Yeah, you can start, sir.
Okay, perfect. Good evening, everyone, and welcome to this post-budget call. I'll welcome you all on behalf of InCred Wealth. We have with us today, you know, three speakers, each expert in his own field in equities and fixed income and overall on the economy. I would like to welcome and also introduce each one of them to you. We have R. Sivakumar. Siva has been, with Axis AMC, and he used to head the fixed income desk for the AMC for a long time before moving to his current role, where he heads the corporate strategy for the asset management firm and an authority on fixed income markets. And I'm sure a lot of you are interested in understanding how is it that the budget announcements yesterday will have an impact on interest rates and hence on investments. So Shiva, welcome to this discussion. We have Rushabh Seth with us. Rushabh is the co-CIO and co-founder at Karma Capital Advisors. He has almost 3 decades of experience, and in that, over 2 decades in money management, primarily into listed equities. Besides being the portfolio manager, he also overall looks at the corporate management at Karma. He's worked with Kotak Mutual Fund prior to this, and also with ASK Raymond James, which is now known as ASK Investment Managers. So Rishabh, thanks for taking time out and welcome to this discussion. We also have Aditya Sood with us. Aditya is an integral part of InCred Group. He heads our equities in the asset management business, particularly on the listed equity side. He also comes with over 2 decades of experience. He's amongst the few fund managers in the industry, especially in the mid and small cap side, who have, on multiple occasions been able to close their funds and give back the money to the investors at perhaps the near peak in the market. So he used to be with ICICI Prudential Asset Management before this. Ran his own asset management business before he joined us at InCred almost three and a half years ago. Welcome, Aditya, to this call. Before we get into the budget discussion, maybe for some of the investors who are have recently started banking with us. A quick minute on Incred. Incred Group is a diversified financial services group. Broadly, we have a retail-oriented NBFC in the name of Incred Finance, and we also run fee-based services on the financial services side under Incred Capital. Incred Wealth is what I represent, and Incred Wealth essentially manages and advises clients on assets worth 25,000 crores plus now. We've been around for 4.5 years, pretty young as far as the wealth industry and our stint is concerned in this space. But there are a lot of seasoned professionals who have come together and are helping clients manage their portfolios and advising them on portfolios. So what we thought is that it's a great opportunity to interact with a lot of you and also to get some of the views of the managers whom we work with very closely. We call them alpha managers who really create a difference in client portfolios. And that's where we have the three gentlemen over here to talk to you about their views and their take on the budget. Right. So maybe with this backdrop and introduction, let me start with maybe a few opening comments from maybe each one of you. On how have you seen this budget pan out? Has it been pretty much on the expected lines? What was being discussed? There was so much noise around what will happen to capital gains, and the markets could perhaps tank. The government perhaps came back to power, but this time with clearly a lot of support from its NDA partners, and hence a lot of learning and introspection for them in terms of do they loosen their purse strings, and hence does it have an impact on fiscal and government borrowings, etc., and hence on rates. So multiple such questions and debates that we've also seen come through in our interaction with investors, and that's where I believe if maybe each one of you could start with some of your opening comments before I get into specific questions that I have for you. So maybe Rishabh, if we could start with you, and then Siva, and then Aditya.
Yeah, hi. Thanks so much. Thanks, Saurabh, for giving us the opportunity for being on this call, and really appreciate it. And thanks for the kind introduction. I think from a budget perspective, I think we've seen maybe more of the same in terms of continuation of what we've seen in the last 5 years of the previous term of the government. Clearly, I think the outlier was maybe a greater push on skill development and employment, broader employment on the rural semi-urban side. And I think the government kind of used the RBI dividend to ensure two things. One is a greater push for employment generation and skill development on a wider scale, which is a big pain point in the larger part of the economy where you still see some amount of distress. And I think the second was to continue focus on the capex, which was not changed from the previous estimates which were given in the interim budget. So my sense is that it was more of the same. Of course, the tweaks in taxation is something which we all know, which have happened both in capital gains as well as classification of various assets within the capital gains arena, and also the change in the personal income tax, a small change in the personal income tax. So I think by and large more of the same, but greater push on employment and skill development, which is very important and much needed from an economic standpoint.
Great, thanks. Thanks for those opening comments. Siva, how would you see this budget?
Yeah, thanks. First of all, Saurabh, thank you for having me on. I think I want to sort of take a slightly macro-ish view on this and a slightly longer term view on this. We tend, as investors and commentators, to look at some of these points in time, a budget announcement or an election, and then try to extrapolate what is going to be sort of a medium-term impact of some of this. And we need to be a little bit cautious about it, right? So if you look at, for example, the election results and the kind of volatility that we saw in the markets on election day, there's very little that markets seem to understand about elections even after the results come out. This time around, we saw significant volatility with the market, especially the equities, taking a beating on the day as the results were coming out. And if you go back in time and you see, for example, 20 years ago, there was a similar kind of, sort of against the BJP NDA kind of a vote, a large fall in the market. And then you got a mother of all rallies, that happened between 2004 and 2008. Right? And then in 2008, in 2009, you had another election. Markets rallied very, very strongly following that election and the budget in some sense, and then had a very terrible few years after that. So one thing is, let's be a little bit cautious about extrapolating near term, especially post-political event results. Budgets are important. I'm not saying taking that away, but we need to be a little bit cautious and look at what are the existing underlying trends and see if either elections or budget makes any significant change to the existing trajectory. I'm here to argue that no, there has not been too much of a change, which is a good thing, by the way, because markets are doing well, economy is doing well, and therefore we don't want something to come and upset the trajectory, right? So one thing is, I think continuity is pretty good. And the fact that the government has largely focused on many continuing factors, there hasn't been too much by way of upheavals. Reprioritization of certain expenditures, especially or prioritization towards employment, etc., are welcome. There has been also, larger conversations around. Yes, there's a lot of push on capex, manufacturing, production-linked incentives, and so on. But why not also support employment and still skills and etc. So I think that there's some part of that reprioritization. I think is a pretty good and welcome sign, right? The other thing is, and which I think is a macro extremely important and probably not as understood, is the fact that the government has gone for a steeper or consolidation of the budget, right? If they really wanted to make this populist and they got a one-off gain from the RBI dividend, they could easily have looked at a higher deficit number. The fact is they undershot their fiscal projection last year. That is, the fiscal deficit came below. And what they have done is essentially they maintained the amount of consolidation for the current financial year. So in a sense, after the interim budget, when the final numbers came out, we found out that FY24 was slightly better than expected, and therefore FY25 they have maintained the same amount of consolidation. I think this is very important. This shows a lot of maturity and a lot of fiscal policy continuity. That one-off or some kind of upside that they've got is not frittered away. And this is something where you've seen a change in budget for policy making this time, as compared to, for example, take a case of where we were in, let's say, 2010, 2011, when you got extraordinary bumper receipts, again, one-off on account of those days, the sort of 3G auctions and Coal India IPO and all that, and government got huge amounts of, and what happened? They spent the money. They kind of expanded the deficit, and the markets didn't like that. And I think this time around, the fact that even if you got a one-off boost, the government has actually opted to, in some sense, save that by reducing the deficit as a percentage of GDP, I think is an extremely important signal to the markets that we are serious about consolidating the deficit and making sure that the deficit comes back down. Even at the current levels, you must remember that the deficit is very elevated, right? Compared to where we were pre-COVID, we were at 3.5% of GDP. Even now, we're not anywhere near there. So the consolidation process is still underway. But it is important that the government uses this opportunity to consolidate faster rather than try to spend its way out. Consolidation is also very, very important in another angle. The people think, that higher fiscal deficits or higher government spending leads to higher GDP growth. It isn't the case. Because when the government spends more, and especially through deficit financing, they're essentially taking away savings from the people, right? That financial savings of investors, savers, goes more towards financing the government than used in private productive assets. The fact that the government has decided to go for a tighter fiscal trajectory leaves money in the hands of the people and enables a faster private sector growth and therefore overall GDP growth. I think this is a lesson which we learned in the 2003 to 2008 cycle, where lower deficits were accompanied by faster growth. And I hope we can repeat that in the current era, where if the government genuinely focuses on cutting the fiscal deficit over the next 3 to 5 years, we may actually see that accompanied with stronger structural growth. It's not to say that we're going to see 8%, 10% GDP growth, but we could sustain higher fiscal deficit for a longer period without runaway inflation if we manage lower deficits. So I am very encouraged. I'm also encouraged by the fact that they've not done too much. I mean, yes, they've done tinkered with the taxation, and in some sense, they've actually made our lives easier in many cases. Speaking now and as an asset manager, also looked at, for example, the complicated number of different taxes and number of different types of mutual funds and other schemes, gift cities become more attractive, and so on and so forth. So they're going to. I think these are important things that the government has done to make some of these things simpler. Rates are going up, tax rates are going up, and I think over the last 10 years we've seen significant increase in tax rates. That's not going away. Tax rates are going up, but the quid pro quo is that the ease of doing business, ease of filing taxes, ease of doing a lot of these things come in, and therefore net we are better off than we were without these changes. So overall, our takeaway is reasonably positive, quite positive. Debt markets especially have sort of gone nowhere, but taking encouragement from the fact that deficits are not rising. And I think even from an equity perspective, if we are able to underpin lower deficits and better consolidation, we should look at a better structural growth story going forward. I keep on going forever, but I'm going to stop here so that everybody else has a chance. We'll come back.
Sure. No, thanks. Thanks for those initial views. We'll pick your brains a little more on the deficit numbers and rates. But Aditya, for your quick opening comments before I get into specific questions on the budget.
Sure. So I think so, broadly speaking, it is more of the same, as Rishabh also mentioned. I think so it is more of continuation that the linkages is what, equity investors will find very interesting, or particularly the stability in the rupee. And that stability obviously continues. Having said that, I think so the equity markets have a mood of their own. 6 months back, if somebody would have told me that, you'll have a coalition sort of a government scenario and you would have, LTCG going up, even though, it was widely getting speculated that, possibly if you have a single majority seat number coming at for BJP coming at 290 to 300, it was a very probabilistic scenario that LTCG could be as high as 15. But I think so one needs to remember that the current regime has introduced LTCG, and this is more of a continuation, and some people are now started to speculate that possibly this 12.5% number will become a 15% number. Whereas the fact of the matter is that this is a way of life now. The other day I was having a chat with one of the entrepreneurs, and he was saying that in my own business in a private limited company, I don't see that kind of arbitrage for equity investors anymore now, because you have the short term being at 20, and if you combine the surcharge, obviously it becomes a much more comparable number. So that tax arbitrage within, sort of different sort of businesses is a thing of the past. I think so. Although I must confess that, if you have a glide path towards long-term taxation, both long-term, short-term, which is would be pretty, sort of much appreciated, like the fiscal deficit glide path. But I think so between the asset classes, parity was required in terms of, having more of rationalization between the slab-based tax rate and unlisted, and listed being a case in point, essentially, right? So that was perplexing to many investors, and I think so that uncertainty is now behind us. At least, it is becoming much more, although I must confess also is that, there is, that we are at a point as far as macro is concerned that there is not too much to worry about. And I think so in last 20 years, what I've seen is that, this is a time wherein, if you clearly think about risk, whether the risk is leverage or it is FISC or it is CAD, or it is the balance of payment, or it is crude, there are not many macro risks that people can think about, because leverage is non-existent at this juncture. And that has been a precursor to, possibly markets not doing well. So most of the, I think so there is not too much to worry about, and that is what the market is taking in its stride. Typically, obviously, from a market standpoint, this is a market wherein, people are more concerned about regulation rather than, any micro risk getting played out.
Sure, thanks. I think that pretty much sets the tone for this conversation. So Rishabh, since you said it's more of the same, but how would you still see maybe some of the schemes that have been laid out in terms of the outlay towards, say, the key priorities that the budget sort of mentioned for a Viksit Bharat, whether it is announcements around the 4 schemes for employment-linked incentives, or there could be a lot more that the government is talking about doing for manufacturing and services in MSME, or for that matter, even in terms of increased productivity in agriculture. So while this might take some time to pan out, also some of the tax changes that have been announced, it's not a major sort of a benefit, but reduction in custom duties, etc. Do you see all of that playing through, coming to your area of work in terms of certain sectors that could tend to benefit, which you will want to maybe try and start limbling into or positioning your portfolios into, something that you are trying to read out of this budget?
I think what we all have seen in the last 4 years post-COVID is that we've clearly seen a K-shaped recovery. And I think the stress that we saw in rural, semi-rural or semi-urban areas, there was a need to kind of address that. And I think they've tried to, with various schemes, tried to address that. Also the need for a certain amount of improvement in credit to MSMEs by guaranteeing credit to the MSMEs and ensuring that greater credit is available to MSMEs, because those are the guys who are the backbone of the economy. You can't run very fast without the bottom half of the pyramid really helping you do that. And we've seen, if you look at businesses that struggled with volume growth, we have seen margin improvements over the last year, but that's basically come from better savings in raw material cost and better efficiencies. But the volume across many industries have struggled, and that's primarily coming from the stress in a wider section of the rural economy. So my sense is there was a need to support that, which is where I think all of these schemes that they've announced hopefully should help in terms of both employment, skill upgradation, guaranteeing credit to MSMEs and smaller players in the market. And hopefully that should help the overall economy. As you rightly said, this is not something which will have impact next quarter, but this is something which over the next 2-3 years, hopefully will have a cascading impact on various aspects of it. So I think overall this is very critical from a longer term sustainable growth, which we are talking about for the economy, because otherwise you have this one-legged thing where one part of the economy is doing well, but the other one is not really maybe firing on all cylinders. Because as they mentioned, the overall macro is good. This is the opportunity we have to kind of push it, that we don't see too much of other macro risk in the environment, and we have a really good opportunity to kind of push this. Sorry, second question. You had the second question was?
So what I was trying to figure out is, given the view that you've shared, and also what maybe could play out as an emerging theme over the next few quarters or about the next few years, any changes that you would do or you would think of doing to your portfolios? You would want to maybe include some of these sectors, go overweight, underweight, or is it too early to even think about that?
My sense is it's still a little early. I would still say how it plays out, how we kind of see the change. As I said, this is more a structural thing which we have to address. It's not something which is going to have an impact in the next 2 quarters. But definitely this is something that you want to keep in mind as you go forward as an investor. And that's something where we have seen maybe some bit of lagging of growth over the last few years. So yes, we will definitely keep this in mind. But I would say that this is slightly longer term in terms of the play. If at all, if you're looking at from an investor standpoint, I think it's not something that you're going to have impact immediately.
Sure, noted. Aditya, maybe a question to you on the MSME related sort of policies or initiatives that have been announced. Do you see that really helping out a lot of these smaller businesses or mid to small sort of businesses? And given your forte in terms of mid caps, small caps, and that area or that segment in the market, anything that you see would be a positive as far as earnings are concerned? Because the question is basically that over the last, say, 1 or 2 years, clearly the broader markets have outperformed, right? And there are mixed opinions around it. While some continue to say that there is still opportunity, while there are a lot who say that there's a 25-30% premium that a lot of these stocks in these segments are trading at. So how much more will it really rally before it takes a breather? So do you think some of the MSME related announcements would really help in shoring up earnings, not immediately, but maybe over the next few quarters? And that should help sustain this sort of a momentum that we're seeing there.
See, one of the big changes that I have seen in the small cap investing landscape in this country now is that, the kind of access to capital that smaller companies have after the JAM, and the CIBIL related scores being available. I practically see every private bank lending to, smaller companies, which was non-existent, 5-10 years back. If you go and speak to companies, you will hardly hear about ICICI or Axis or HDFC giving very fine rates to, smaller companies. I think so. So that is one part of financial, intermediation story, which is, very well recognized. I think so. What was required from a budget standpoint was to focus more on the value chain of manufacturing, which obviously is emerging as a very, very large theme. Nobody would have imagined that, 17% of Apple iPhones are going to get manufactured within a very short span of time, which was non-existent, 3 years back. That is part of the Make in India program. So what we essentially see is that, this value chain has to be fully supported. And this is what they have done, possibly, having a 100 crore sort of a loan without having collateral is the announcement that was made on the MSME side. And that kind of support is required because at the end of the day, there is an ecosystem that needs to be supported. It doesn't happen in isolation that, you roll out a PLI sort of a SOP for the larger guys in the industry and, the vendors ecosystem is not supported. Because if the entire manufacturing story has to play out, and this is what precisely, people like Maruti have done. They have a vendor scorecard, which is very, very clear. And they are very clear in their philosophy that, if vendors don't survive if the vendors don't prosper, we don't prosper as a company. So I think so. These are steps in the right direction. Secondly, I think so there is a larger aspect of employment also, which is linked to MSME job creation because, with obviously automation coming to the fore, one of the most challenging aspect of any government globally has been to create jobs, right? And this is what is impacting. So there is an interlinkage between, why 2 states were possibly favored, this time around. Obviously, it has got to do with the politics as well, but it has got to do with more, sort of creating a competition between states. And this is precisely what is happening in US at this point in time, right? Because we see, states competing with each other. So I think so that is required as far as access to capital is concerned. There is abundant capital which is available. If you look at the SME boom in this country, it might not end well, but it gives access to capital because we don't have a venture ecosystem in India, right? Because it is a switch on, switch off sort of a tap, right? Because it is too dependent upon what is happening to venture financing from the valley to India, right? And I'm talking about the USA here, essentially. So I think so. Access to credit is not a issue, but what they are trying to do is to fine tune the manufacturing story. Obviously, credit guarantee would help, and if it comes from an institution of credibility, obviously it helps a lot. So from a purely standpoint of markets, I think so. There are certain segments of the markets which are very, very overheated, and there are some market capitalization on the small cap side, which is unprecedented, and they are also unsustainable, I would say, to a certain extent. That is very, very clear. But I think so, this being a very, very large space, because practically in a market like India now, but for top 100 companies, everything is mid and small, right? So how do you, sort of work through that and have a framework in mind in terms of, I mean to say, if I have to think purely as an investor, I've got such a large repository of companies to work through, basically. So, saying that, but for 250 companies, everything is in this country is a small cap, right? We have seen 3, 5, $10 billion companies being called small cap in this country today. So that is a very, very interesting sort of a backdrop to have. But I think so from a standpoint of investors, it makes sense to get more aligned to the government. I think so that is amply clear. Whatever, and this is what we are seeing that, wherever government is doing capex, if you get aligned to government's agenda, that is the best outcome for investors generally.
Sure. Thanks, Aditya. Siva, let me come to you and maybe ask a few questions on how to play the yield curve. Okay, so I mean the numbers as far as fiscal deficit is concerned, seem quite credible, and the government has sort of delivered a very optimistic, fiscal deficit target for this year, and also a very optimistic target for the next year in terms of the decline that it anticipates. But somewhere, I mean, if you look at it, well, we were also watching, and a lot of participants would have been watching on screen. The 10-year seemed to have come down significantly during the budget speech of the finance minister yesterday, and then maybe we saw some bit of pullback from there, and stable at around just under 7%. Is that, I mean, that seemed to be a pretty much a subdued sort of market reaction or optimism. Is that because of a modest 12,000 crores reduction in borrowings, or is there something more to it? Because these numbers were definitely much better than what maybe the street anticipated.
I think I want to sort of take one moment to also go to your previous question. I think it's a little important. That question is a little bit important from another angle. I think that both Rushabh and Aditya mentioned, I think, quite a few important points. I want to underscore one point, which is this bringing back this K-shaped recovery thing, right? That we've seen so much of focus and so much of growth in parts of the economy, and then consumption and certain, especially private consumption definitely lagging in numbers. Rushabh alluded to the fact that certain companies have not been able to see volume growth, etc. So when you look at it from a macro perspective, clearly the focus to shift or pay equal attention also to the consumption part of the economy. The consumption comes from where? Consumption comes from income growth. And income growth comes from where? Comes from the job creation. If you look at the economic survey which came a day before the budget, there are a lot of ink spilled on MSMEs and as a source of job creation, etc. So all of these things kind of tie in together, right? Why is there so much of focus on MSME? Why is there so much focus on employment linked incentives? I think there is a shift. There is an understanding that you can't just have a manufacturing-driven economy. You can't just have an export-driven economy. You can't just have capex-driven economy. You also need to get consumption back on track. Every part of the economy needs to fire. I think this is something we need to keep into account, that this government is actually looking at all the engines. Maybe they prioritized manufacturing through the PLI and other schemes in a previous budget, but this budget focus clearly is on also trying to even the playing field between manufacturing and consumption. So that's something to keep in mind, that it's not just about the hard assets or the manufacturing setup or high end, but it's also about getting overall consumption, overall economic breadth of the economy in some sense, kicking at all levels. I just want to make that comment because it's important, I think, to understand the thematics behind some of the budget proposals, right? And that might have a significant impact on how we invest, especially in equities, because it's as Aditya also said, right, you need to invest with the government. The government has been sort of giving sort of priority to manufacturing and hard assets over the last few years, capex, etc. Focus of markets were there. If the government is prioritizing consumption and employment, then the market may also shift into those assets. So something to keep in mind when we are making our investment decisions. Now, to come to your point about fiscal deficit and especially the borrowing program, and why is it that the bond markets have not reacted? I think the bond markets were expecting a sub-5 print on fisc. So I don't think there's a major surprise for bond markets over the borrowing program number. It's not about the last few thousands of crores of borrowing, right? It's about the larger picture. the fact that they are sticking to a tighter, in some sense, not spending that additional headroom and going with consolidation, and again committing to a 4.5% fiscal deficit for the following year. It would have been great if they're given a still kind of sort of another year or two more kind of focus about where they see fiscal deficit coming to, but at least the fact that they are maintaining or lowering the fiscal number rather than going for any expansionary thing is, I think, good news. So bond markets, tepid reaction, but more because risks didn't play out, right? It's more about the fact that could things have gotten worse? No, they didn't, so everybody's happy. What
Sure.
is bond markets looking for, right?
Yeah.
It's that now that this event is behind you, the focus clearly shifts to the RBI, right? So the fact that the government has now said that, listen, we are not going to take this, RBI largest and spend it out, etc., but we are going to actually consolidate, gives RBI a lot of ammunition to change its monetary policy stance. And I think that's something we really need to be looking forward to. It's coming up in the next couple of weeks. So it's going to be something which we really need to look forward to see what they will do. Now, will the RBI cut ahead of the Federal Reserve? I don't think so. So you will still probably want to wait and see what the Fed will do in September or beyond for the RBI to really open up its rate cut window. I think the rate cut window for the RBI is after the US Fed, but timing could be this way or that way. It's not so important. For the RBI, clearly the fact that the government is not going for an expansionary budget should give them more confidence that they can keep the wins in some sense on inflation for a longer period of time. They're not at their 4% target, and I don't think they even need to be at their 4% target. But already ex-food, your inflation, the core inflation in some sense has been below 4 for quite some time now. And if food inflation starts to taper off towards the end of this year or next year, that gives RBI a lot of comfort in terms of starting to cut rates. Even if the RBI were to cut rates, we are not looking for a large rate cycle this time. So we're looking at maybe 2-3 cuts, 50, 75 basis points of rate cuts. And that may push your long end yields down a little bit. So we've been calling for some time that the 10-year will go to 675, maybe a little bit lower. And if we really see a larger cycle, led most likely by external factors, maybe we can see a larger rally. But this is a rally you want to play in the yield curve. Yes, you want to be longer duration, but don't expect this time that you're going to see sort of 100 basis point rally or something. We are talking about 20, 25 basis points kind of move in the long end, which will make you a lot of money, but these are going to be more in the nature of sort of that little bit of excess return rather than some extraordinary kind of large move in bond market. So this is a market where you play the rate curve, but you're probably as good playing, let's say, high yielding assets at the short end, which can also give you that kind of excess return that you hope to make.
Just one more question, maybe if you could answer, because you're the only mutual fund sort of representative over here. There has been custom duty on gold and silver decreased. A lot of changes to capital gains taxation, tenor rates, etc. For fund of fund and multi-asset sort of fund. So any internal discussions or communications maybe which as an asset manager you would want to make or focus on post this budget announcement towards multi-asset class or multi-asset allocation sort of fund?
It makes a huge difference for us non-debt asset classes, right? So basically you earlier had one tax treatment for equities, which was 10% long-term after 1 year, and then one tax treatment for everything else, which was below 35% equity, which was marginal, right? So there was a huge gap in the tax treatment. Now you have largely aligned. Most assets are now going to be 12.5 long-term. The long-term can be 1 year or 2 years, but only the debt funds which are above 65% or above invested in debt and money market will be marginal, right? So this is a big change because it opens up the entire multi-asset fund of funds and all of these active strategies into play in terms of having in some sense, fund managers don't have to worry about the tax implications of their decisions when they're making asset allocation decisions, right? If you've got, let's say, a multi-asset which is taking a dynamic call on equity versus debt, or equity, debt, and gold, or any other commodities for that matter, or if you're running fund of funds in a multi-asset strategy, because you're tax neutral and everything is long-term 12.5%, I think it opens up a huge space for multi-assets as a fund house, right? So I think there will be a lot of focus from us and from the industry in multi-assets. going forward. I think that category will see more innovation because there will be a lot of push to create more products which are tax neutral. So the focus, I think, from the industry and from clients in some sense has been towards equity and equity oriented products. Even the hybrid funds which have seen flows have largely been funds where you've had more than 65% equity, right? So as to, because there's a huge difference in taxation between equity and non-equity asset classes. Because that has been narrowed, I think you will see a lot of asset allocation neutral or tax neutral asset allocation decisions, or more active allocation decisions, which we'll see going forward.
One question for you, Aditya, on sustainable energy transition efforts from the government. So, any views on renewable energy space in the medium to long term, and how will you maybe play them in your portfolio? I'm not sure if there are too many opportunities, but if at all, what would be your preferences there?
So I think so. Our approach generally has been that, we look at, see, more or less, the thing is that, most of these stocks are like now fairly priced. One of the most challenging aspects of investing into the capital goods side of scheme of things is that, the index itself is trading at 10 times price to sales. Pretty much everything that you think about is trading at 100 PE multiple. So it is not a very easily investable space now, and it is fraught with challenges. So my experience is that, possibly we look at, some second derivatives which can benefit. For example, it is not that if I'm very bullish on wind energy, I should go and buy Suzlon or, possibly Inox Wind. It is going to be challenging. Possibly, it can be played through a crane company, for example. Right. So second derivatives are much better. What we are also seeing on that space is that the heavy lifting is going to be done by the biggies now, right? And that is, for example, there was something which was got to do with the nuclear energy, a JV between NTPC and BHEL. And slowly what we'll see is that, a lot of these larger companies will start to list their renewable side of the business, right? It could be a Tata Power, it could be NTPC. So those opportunities could be, sort of real opportunities that come through. Because what you are backing here is that, it is a combination of backing a sovereign with an excellent track record. So I think so we have to just wait and watch. Second thing is that, pretty much everything in this space has gone up, without any, one is that, we have not, this is a unique bull market that I have seen in my career, wherein, typically people say that bull markets climb a wall of worry. So you don't have anything to worry about on the macro side. The second very interesting aspect is that we have not seen a correction. And this is not true of markets in India. It is true of markets globally today, right? So if you see Dow 2.5% correction over a 15-month period, what does it tell you, right? So I think so purely from that perspective, it is reasonable for one to, sit on the sidelines for time being and, expect some correction. And as and when that correction comes, obviously we also know that bull market corrections are very sharp and swift, and they are treacherous in a way that, within a short span of time, you might get an opportunity to position yourself. Because what typically happens is that, some investor would have bought a stock, 4 years back and would have made, 5x, 6x money in the stock. And there is a bit of earning disappointment. I think so at this juncture, our approach has been to wait for those times basically, and correction will come through, which is a normal course of the market. And we will capitalize to position our, clients accordingly.
Sure, interesting. Rishabh, one question for you before we open it up for the participants on the realty sector. So while the change in indexation, capital gains, etc., has been looked at as a dampener for those who are holding older properties, etc. But also a lot of announcements under the PM Awas Yojana for 1 crore urban poor and middle class or middle income families. Over 10 lakh crores of investments. Do you participate through your funds in real estate as a sector segment or any allied sectors? Any comments over there?
Yeah, we do participate. So I think overall real estate cycle is still, I think maybe we are in the middle of the cycle. Like everything else, it will go through its own ups and downs. My sense is we still have some way to go. I think the need of the hour is to build more affordable housing. Generally what we see as catering to us investors is maybe still the slightly higher end of the mid and maybe the higher end segment of the market. I think the 10 to maybe 30, 40, 50 lakhs is really the big need of the hour in terms of the housing, overall housing requirement. And of course, there are various ways to play housing. You can play housing directly or through real estate, or you can play it through various companies which cater to the second derivative of the housing market. I think maybe one thing I would like to add, maybe which is maybe not covered, and is the need for maybe the direct tax reform. I think the direct tax, the government has spoken about the putting in a commission for reforming the direct tax. My sense is there is a crying need of the hour to reform the direct taxation. There are too many, according to me, there are too many slabs, too many complications still, despite of a new variant of the tax scheme coming in. And I think if after 6 months, if we can get something which is more simpler, will help compliance dramatically, and also ease out the taxation for individuals, like we've seen for the corporates being done in the about 4 or 5 years ago. So my sense is there's one big need for reforming direct tax, and that direct tax reform hopefully should come through post this commission putting out the report in the next 6 months.
Sure. Thanks. That's a fair point. Ladies and gentlemen, I'll request you to make use of the chat box and to type in your questions for any of the three panelists. Any queries that you would have around the budget, anything to do with equity, fixed income, macro, please feel free. The question queue is now open. Sorry. We have one question on arbitrage funds, especially post the rise in STT. Do you think there's any impact on the returns of arbitrage fund, given the change in F&O STT from 0.01 to 0.02 and 0.06 to 0.1?
Yeah, maybe I can take that. I think most arbitrage funds are pretty much all arbitrage funds basically own stocks and short futures. So obviously the fact that the tax rate, the STT on futures have gone up will have some impact, but not as much as options, right? Because the tax on options has even increased significantly on the futures. So to put it into perspective, let's say if in a given month, your role in some sense yields you in arbitrage terms, maybe 70, 80 basis points for a given month, let's say 80 basis points. Maybe you may end up paying, if in the past, you maybe ended up paying 1 basis point as tax, little over 1 basis point, and now you're paying 2 basis points. It does drag your yields, but not quite by as much as you think it does on a monthly or for an annual basis, right? So it is going to impact the roles, but the tax rate increases not as much as in the case of options, and nobody uses options to hedge in arbitrage. It's basically futures. The second impact, of course, is going to be the increase in the tax rate. As arbitrage funds are classified as equity-oriented funds from a tax perspective, the tax rate on short-term goes up from 15 to 20%, and the tax rate on long-term goes from 10 to 12.5. So obviously, then post-tax returns does get affected to some extent, and therefore, for some class of investors, the impact of both the slight potential drop, I should say, because it's not a given that there will be a drop in yields, but the tax could have some impact, especially the short-term investors may want to relook at some of the calculations around, let's say, going to a shorter duration money market kind of category debt funds and arbitrage funds. may want to revisit it if it's appropriate. I don't have any specific calls on that, but it's something to revisit, especially if you're a short-term investor. If you've got longer-term money, obviously it doesn't matter because still there's a significant tax arbitrage between arbitrage funds which are taxed at 12.5 and debt funds which are at marginal rates, right? So for many investors, that should not be a huge impact.
Sure, thanks. Another question is on significant focus that the government had clearly on education, upskilling of people, also employment generation. So, do you find any thematic sort of opportunities here? While people generally talk about a more diversified portfolio, but any particular themes that one could tactically try and pick up? Maybe any one of you, Rishabh, Aditya.
At least I can't think of anything currently offhand in terms of based on skilling and education. I think education is very critical, but we don't see any direct play on it. I mean, I let Aditya or Sivakumar if they want to add anything.
I think so. Yesterday, if you look at, TeamLease and Quess are the two companies which are TeamLease obviously is more of a staffing company. Obviously TeamLease was up. Essentially, the sector is unorganized. It is not very organized and difficult to play this through. In a very focused fashion.
Sure.
Coming just on the week where we had India's most sort of flagship education startup getting dragged to NCLT, it's not necessarily something which you want to play thematically from a bottom-up perspective. Even if you think that there's a top-down reason to buy that sector. So it's not a sector which has got so much of opportunity to play. Maybe a little facetious, but I think let's not play everything that the government tells us to play.
That's a valid point, Siva. Another question that's on generally the agri part or the agri economy and allied sectors. So whether it's fertilizers or through the auto segment that caters to agri as a business or as a sector, anything there you see potential for sort of taking exposures, increasing exposures? We already are playing those themes in your portfolios.
So from an agri standpoint, I think so. We have been very, very vocal, and we are equally vocally bullish about the prospects of rural India. And I think so. We are still at a very, very early stage because if you look at rural incomes post COVID, they are just recovering. They are just coming back to that pre-COVID high, and there is significant scope for that sort of a complex to sort of improve. This is getting now. If you logically think about it, two-wheelers as a sector has done well. It is a very large exposed to rural India, and now what we are seeing is that low unit consumption, as I think so Rishabh also mentioned. What we are seeing is that volume growth was practically missing, and there was a K-shaped recovery across. So what we are seeing is that volume growth is slowly returning, and anybody who has invested seriously into go-to-market as far as rural is concerned, and I'm talking about essentially the staple companies here, HUL or a Dabur, has started to see some green shoots coming through. And what we have seen, in fact, in certain cases is that, rural growth is outstripping the urban growth also, purely in terms of volume terms. And it was logical to expect that because typically in an election year wherein you see so much of spending happening, it gets, supports the rural economy. And obviously this is once in a 5-year sort of a phenomena, but the thing is that one nation, one election is a reform that somebody should be expecting going forward. How it implements, we'll see that. But I think so low unit consumption wherein volume growth is returning is definitely is of interest to us, both on the consumer staple and durable side.
Sure, Aditya. Anything in your portfolios, Rishabh, that caters to this part of the economy?
Yeah, as Aditya mentioned, I think we are playing. We have some consumer durables as well as a second derivative of two-wheelers, basically companies which auto component suppliers to two-wheelers, because basically that kind of covers broad range of two-wheeler manufacturers, not just a single brand kind of thing. So very similar, I think, views. My sense is the monsoon is maybe far more important than anything else to the rural agri demand. And hopefully we are seeing a reasonably decent monsoon till now. So if that continues, maybe in the second half of the year, you will see some improvement there.
Sure.
Step in here very briefly. Just want to sort of pick up on something which I already said before. I think the thrust of the government in that sense seems to be on, or at least the past thrust was on two parts. One is on manufacturing, others on sort of hard assets, capex, that kind of stuff. And this time the thrust seems also to be on consumption. So in a sense, the part of the economy which is not fired so far. So in that sense, I think if you were to look at it as an investor, given the amount of money which has gone into sectoral and thematic mutual funds over the last year or two, chasing after some of these, I think might make sense to look at a more balanced portfolio, balance also towards a little bit towards the consumption themes, not just your capex and manufacturing and some of those things. So it might be interesting to look at mixing a portfolio up a little bit in favor of consumption. The fact that consumption has underperformed for the last few years, and real economy terms, not markets, and if that turns around, it could be a huge change in terms of where the pockets of profitability are in the future as compared to where it's been over the last few years.
Understood. A question related to the announcement towards the eastern parts of the country, especially states like Bihar and Andhra, Odisha, etc. Any specific businesses do you think over a period which could which have a lot more geographical focus there, which tend to benefit? That's one of the questions.
I think we are maybe trying to thread the needle too much. I think I would rather keep my eyes on the slightly bigger picture rather than trying to, as Shivkumar mentioned, chase every announcement that the government makes. My sense is, for example, for us, say we are paying payments. If the economy and consumption recovers, I think payments is going to be a very large opportunity. And this is something which is a structural opportunity in India where you're going to go to more and more digital payments. So I think there's many ways of playing it, and you don't need to really chase every announcement. I think as an investor, we need to keep our eyes out in terms of taking a slightly bigger, broader picture in mind. I can't see of anything to those particular states, but I'm sure there might be a few companies that benefit from that.
Sure. I don't see any further questions. Well, there's one on electronic semiconductor devices. The government's focus is clearly going up on that space. Any direct, indirect beneficiaries of this? Either of you could take it.
I think so. Broadly, the heavy lifting would be done by if you look at the semiconductor value chain, it is so complex and complicated that, the heavy lifting would be done by, a few industrial houses which are getting deeper into this space, right? And obviously Tata's is one, because they have a entire ecosystem of, focusing right from, having a tie-up with Foxconn in terms of, assembly of an iPhone to possibly thinking about setting up a fab, because ultimately all these businesses are very, very heavy capital intensive, and they don't have a payback period visibility any which ways, because the way technology works is that possibly you have to risk too much of capital, and that is a real moat of possibly Nvidia today, right? That even if I have to start, somebody has to start today. It is not about the capital. It is about whether it is you are going to be successful doing that. Your probability of success is really very minuscule. So I think so. It is better to focus on large houses here, wherein they have the muscle power, they have the technological prowess, they have the ability to tie up with the global giants and bring them to India. Innovation is going to be very, very difficult here. As we have seen in the case of, Taiwan versus US in terms of the entire semicon manufacturing ecosystem is in Taiwan. So I think so that is there. Apart from this, I think so PLI has done a great deal of service in terms of, supporting the EMS manufacturing ecosystem. Now these stocks could be, very expensive, which is altogether a different thing. But a lot of these companies were also closer to bankruptcy, before getting IPO'd. But I think so, there have been clearly success stories here. If you look at the manufacturing ecosystem, and it is all through, it is not necessarily in high-tech manufacturing. It could be in plain vanilla products like fans or, air conditioning, outsourcing. So there are various opportunities, basically, not necessarily on the high-tech side.
Sure. Thanks, Aditya. Siva, a question particularly for you. On the duration side, where do you find the most optimal sort of risk reward? It's more medium term, more long term, or extreme long term, given that the yield curve is almost sort of flattish.
Yeah, at this point of time, my initial message would be go at least a step beyond where you are. So if you have been traditionally a investor in, low duration, below 1 year category, at least try to push yourself into a short-term category or something. If you're traditionally a short-term investor, look at a medium term. At least push yourself out there to take a little bit of risk. The risk of a blowout in yields are quite limited at this point of time after the budget and with the global environment also turning favorable. I think at least take a little bit of risk in your portfolio. Tactically, of course, you can buy long, right? Whether you buy a longer term gilt fund or a long duration fund, etc. That's a perfectly valid way to play a part of your portfolio there. But you don't really need to make massive shifts in your portfolio to do that. I think at least make sure that you're participating reasonably well. As the flat yield curve over the last year or more now means that. And with low volatility, which means that if you just stay invested in money market type of an asset, or if you are in duration, you got much the same outcome, but one had more volatility than the other. So you had a more volatile ride, less volatile ride, but broadly give or take similar returns. But that's not the game if rate cuts actually get going, right? Because what happens in a money market type of an asset is that every rate cut happens, you reinvest into a lower yielding asset. So money market or liquid funds and all these things, in a rate cut environment, they keep losing yield as you go, right? Because you keep rolling over into new assets which are lower yielding than before, but duration assets obviously gain because of market. So this is a point of time when you want to at least move from the very, very low end of the curve to something in the duration space. As I said in the early part of my comments, this is not a large rate cycle. We're not expecting massive rate cuts, 100, 200 basis points. We're talking about 50, 75 basis points of rate cuts. And if that is the kind of game we are playing, then we are not really looking at substantial changes to our portfolios to capture that gain, right? We just make smaller changes to the portfolio. But please stay invested at least wherever you're comfortable with in the duration space. Get into that. You don't have to be very, very long, but I think it's well worth playing duration to some part of your portfolio.
Sure. So I don't see any further questions. So maybe to conclude. The budget clearly takes out, hopefully, as in any sort of large remnants of doubt with respect to continuity of policy that the government has been showcasing for the last so many years. So maybe a quick 30-second sort of closing comment from each one of you, on the budget and the way forward. Conclude this interesting conversation we've had. Maybe Aditya, we could start with you, and then Rishabh and Siva in that order.
Yeah, so I think so. It is more of the same. One thing that we have to remember is that, now we have the GST Council to do the heavy lifting, basically, right? Earlier, you used to have budgets which everybody was focused on the sectoral impact, and now suddenly we see that, the sectoral impact is minuscule. So such is life, basically. But I think so. It is more about how the Ministry of Finance, RBI, and SEBI thinks about the glide path. Clearly, the bigger, sort of issue which we didn't touch on has been deposit growth and the credit growth. in the system, there is a huge, sort of an imbalance which is getting created. And obviously, the second side is the, obviously this talk about, too much of regulation from a FNO perspective. So it is much more of the same. But I clearly have, would have wished that we could have, some sort of a glide path towards LTCG taxation from a long-term standpoint.
Sure. Rishabh, your comments.
No, I think I completely agree with Aditya in terms of the GST. I think GST rationalization is also something which is very, very important. Again, I think we started GST with a very different view and different world. In the last, 6-7 years, we've seen significant changes. I think there is a need to reorient the GST structure to the newer reality of India. And I think similarly, there is a need to, as I mentioned earlier, relook and rethink the direct taxation in India. Still, I think there are too many slabs, too many things, too many moving parts to it, as Aditya mentioned, in terms of glide path to LTCG. By and large, I think taxation needs to be, the direct taxation needs to be looked very holistically and simplified in a very similar manner like we simplified the corporate taxation. So I think rationalizing GST and rationalizing direct taxation are two very, very important things which maybe need to be addressed over the next few years from an economic standpoint, and which are very structural and hopefully should continue to improve compliance, which has been a big driver of tax growth in taxation for the country.
Sure. Thanks. Thanks, Rishabh. Siva, over to you.
Yeah, just a couple of comments. One is I wish we have fewer and fewer budgets, impactful budgets, because less volatility there is, better it is for all of us. It's the first thing I would say is that I hope we have more non-events than events going forward. And this time's budget is close to a non-event in terms of the venture impact market was relatively contained on the day despite volatility, right? I think if we have such events, it's actually helpful for us if you're building long-term portfolios. We should not be reacting to shorter-term events. As investors, we should be looking at where we are deploying our capital for the longer term rather than worrying about every little announcement. And I hope that is one important thing. I'll also like to sort of pick up on what Rishabh just now mentioned about simplifying the tax code. There was mentions about that, and I think that's something which this year is going to be a big thing. Maybe we can bring back the DTC from 2008, was it, and see if something like that is going to get implemented. And it is very important that we kind of standardize and move past this near-term tinkerings. And so I think it's good. Overall take on the budget is generally positive, which is pretty good. And why I'm not singing more praises is because it's good that way. Since we don't want, like I said, volatility. So it's more all marks for continuity budget.
Perfect. Thanks. So it's been a very interesting last 1 hour or so, and I think even the participants would have enjoyed hearing out your views on the budget. Thanks for taking time out and taking us through your views, ladies and gentlemen. That's all we have on this call today. Thank you for having been a part of it. That's all from our side. Thank you, everyone.
Thank you. Thank you
Have a
so
great
much.
evening. Bye.
Thanks a lot.
Take care, guys. Bye.